The cost of borrowing money soaring even higher after the Federal Reserve hiked interest rates again yesterday, despite the most intense banking crisis since the Great Recession. The Wall Street Journal writing that Fed Chairman Powell is basically walking the tightrope as he tries to balance the fight against inflation with protecting the financial system. Joining us now is Maria Bartiromo for a deeper dive on this. The Wall Street Journal also said this, that trying to walk that tightrope is a strategy that is fraught with risk. Quote, one danger is that the Fed's lender of last resort activities prove insufficient to control a larger bank panic if one develops, prompting pressure for a sudden easing of interest rates, no matter the inflation rate at the time. The Fed could be forced to ease before it has conquered inflation. You talk about a balancing act here. This one is pretty precarious, and the ramifications are huge.
Yes, they sure are, John. And I think that came across yesterday with the Federal Reserve really walking a fine line in terms of telling us that the banking crisis has eased, but also telling us that the Federal Reserve is watching the banking crisis for its ultimate impact on the economy. Look, we know that the Fed has raised rates 9 times, and it takes about 1 year of a lag effect to actually feel the pain and feel the impact of those higher interest rates. We are beginning to fear it. We feel it. We've seen it in a number of interest rate sensitive segments like real estate, like the auto area. But I would expect that we will continue to see an economy that is slowing, and there are many expectations that we will see a recession later on this year. The one area that seems to be holding things up is this very tight labor market, and the fact that we continue to see jobs created. We continue to see people leaving, going to different jobs, trying to be competitive. And as a result, that is the offset to what appears to be a weaker economy. And on your note, in terms of cutting interest rates, I had one guest on the other day that told me he thinks the Federal Reserve is going to be cutting interest rates by July 4th weekend this year. Others, like Nancy Lazar, who I spoke with earlier from Piper Sandler, says we're expecting a recession at the end of the year, and the cuts will start next year in 2024. So there's no doubt that this is a real balance that the Federal Reserve is walking, that we are in a slowing economy. Higher interest rates certainly have represented a shock for a number of businesses. And let me just add one other warning sign, John, and that is right now you're talking about $1 trillion of debt that will be rolled over. In other words, that debt will come with higher interest rates because the rates have been rising. And when you've got businesses that were paying 4% for their debt, but are now paying 9% or higher and going higher, that's a big deal. I would expect bankruptcies this year as well.
Yeah, it's going to add a lot to the cost of carrying that debt. You mentioned recession, and to that point, the White House sees it completely differently. Listen to what Karine Jean-Pierre said.
We do not see a recession or pre-recession. We see a strong economy, and it's because of the work that this president has done.
They must have an entire crate of rose-colored glasses in the White House, because they appear to be the only ones seeing it that way.
Yeah, well, she's got her talking points. I'm not sure what Karine Jean-Pierre is looking at in terms of research, but I am looking at the monthly numbers, and we are looking at an economy that is certainly slowing down and is likely to continue to slow down. Recession either at the end of this year or next year is pretty much baked in the cake for the economists that I've spoken with.
All right, Elizabeth Warren, she does not like what Jay Powell is doing at all and really is calling for his head. Listen to what she said.
Do you think the United States is headed for a recession?
I think that is where Jerome Powell is trying to drive it. That is a danger to our economy. It's why I said 5 years ago, I think he's a dangerous man to have in this job.
She didn't just say that he's going to accidentally trigger a recession. She said that he's driving it in that direction. He's dangerous, and he needs to go. But I don't think the president's listening to Liz.
Well, I don't think that anybody wants to drive the economy into a recession. I think the Fed made major mistakes by keeping interest rates as low as they were for as long as they did. Let's face it, you had interest rates at 0 for 15 years. 15 years. And then all of a sudden, in 11 months, we go from 0 to 5%. That's a shock. It has been a shock on many businesses. It's going to be a shock on consumers. Let's face it, rates right now, when you're talking about credit card rates or other rates, mortgage rates, you're talking about the highest rates in decades. So already we've seen an impact. I don't think Jay Powell is, really thinking, I want to drive this economy into a recession. I think that's partly Elizabeth Warren trying to run for president. But I do think he's made a lot of mistakes in terms of monetary policy, and he's trying to figure out how he's going to get himself out of that. That's why we talk with Thomas Honig a lot on Fox Business, on Mornings with Maria. He was the one dissenter, John. Back in 2010, Tom Honig said, no. Too much stimulus. I'm not on board with taking interest rates where you want to take them. The one dissenter, he was the right one to follow.
Well, Janet Yellen has said oops in the past. We'll see if maybe Jay Powell does one of these days. Maria, great to catch up with you. It's been a while. Appreciate it. Thanks.